it should be bottoming by my work by about February, March next year. So the economy is about to go off a cliff. And I don't think the market is yet prepared for it. So let's go back to this Jackson Hole thing. What did they tell you? They didn't tell us anything new. They said, we really want to get to 4% and hold it there depending on the data. Well, the bond market, if I look at Eurodollars or Fed funds, they're already at 4%. So the market's priced that. So there's nothing new. So I think, okay, there's nothing new there. So if the economy starts getting weaker, because the Fed said they will be more data dependent, then we'll see the bond market starting to price in lower rates in the future. So I'm looking at that. And then the Fed said, well, they will change their mind if inflation comes down a lot and unemployment goes up. So the forward-looking inflation data is already falling fast. My work suggests it could go negative in 18 months, which is something I've been talking about a while when I've been looking at, for example, the example of 1947, when people all came out of World War II, went back into the labor force, much like the pandemic. We had no supply because nobody was making everything because everybody was at war. We had this, prices went up 20%, 18 months later, negative 3%. Then it had a rebound effect and then balanced out. I think we've got something similar playing out now, which is contrary to the narrative that we've got sticky inflation. Everyone looks at the 1970s, that's what we're doing again. Unless the Fed crush it, they're Arthur Burns and we're going to ruin it. Well, in the 1970s, we had this massive demographic boom that kicked in just at the wrong point, which was the baby boomers entering the workforce. We have the opposite. We have in 2023, the record peak number of people hitting 65 in the US labor force. And that means peak retirees. So we've got peak retirees happening, and we've got demand destruction driven by this economic cycle. So the forward-looking inflation data to me looks like, if I look at commodities, I look at a bunch of things like new orders versus inventories in ISM, that they go negative. Okay, that's the extreme. That's actually my base case. Maybe I'm wrong, but inflation is coming down significantly and very fast.
Hello and welcome to Money Talks. In today's video, Real Vision CEO, global macro investor and crypto analyst Raoul Pal updates about macro, crypto, and everything within the market. Raoul shares his big picture thesis about the current situation of the global economy and why he believes that we're heading towards a sharp recession. Raoul also explains why liquidity going up is good for asset classes, whereas liquidity going down is bad for asset classes. Make sure to stick around till the end of this video where Raoul Pal reveals his crypto outlook for September 2022.
And then we'll see on the other side, when you've got this yielding asset that is a giant in the space, what that unlocks in terms of DeFi, the opportunities for institutions to invest, and other opportunities that come from a different asset. Also the ESG credentials. You know, we all know that Bitcoin ESG credentials are not what the ECB or others will tell you, but that's the narrative that's won the institutions now, that Bitcoin bad, but proof of stake, good. So I think all at the margin, it helps people allocate. This magic term you hear all the time, liquidity. How much money is available or how much is not available? So when the amount of money is growing, well, there's money everywhere. We can do stuff. Now, it means that it's easier to borrow money from your bank. It's easier to get a mortgage. It's easier to do all sorts of other things. But it also means that businesses have easier access to capital. Banks are not hoarding capital as much. So it means that money flows throughout the financial system. We're a system based on leverage and liquidity. So when money supply is shrinking around the world at the same time, it means that it's going to pull down all assets. And in fact, when we look at it, the bond market has lost $19 trillion in value globally. The equity market's lost $21 trillion in value. let alone real estate, crypto, all of these things. We've lost something like 40% of global GDP in this pullback. I mean, that's a lot of wealth that's been destroyed.
Bitcoin price currently auctions at $19,830 as retail traders are jumping into the market to place their bets on the next directional move. Since August 1st, the peer-to-peer digital currency has fallen 20%. As today's trading session is close, the technicals could hint at more decline for September. Statistically, the cryptocurrency market has not performed well during September. The past 4 Septembers have brought negative returns for investors. The volume profile indicator shows an uptick in transactions as the Bitcoin price has breached and has been denied re-entrance from the $20,000 barrier. The last-minute influx could be the nail in the coffin to push the Bitcoin price towards $18,800 in the short term.
So we're starting to see some of the regional Fed surveys falling apart. But what I'm really looking at is the ISM survey, the Institute of Supply Management. That's a survey of basically buyers in large corporations and industrial companies about how they see conditions. They tend to do a very good job of tracking the business cycle. GDP follows it. Now, there's this magic number, which is 47. 47 is the level at which it has a 100% chance of recession. Now, we're still in the 50s, low 50s, but all of the forward-looking stuff is going down to 47.
Last week's bearish trade setup is still in motion and has not been validated. The bearish target is $18,900 and the invalidation level remains at $27,000. A breach of the $27,000 zone could kick off the next crypto bull run with midterm targets around $34,000. Such a move would result in a 60% increase from the current Bitcoin price.
Housing is the 5th largest employer in America. It looks like that they will start laying off workers pretty fast because they've got massive inventories. Everybody from Amazon to Walmart said we've got too much inventory. They're all laying off staff. Everybody's starting to lay off staff. All the tech companies are laying off staff. So I think we're going to start to see unemployment and inflation falling, the economy falling sharper than people expect. We're already seeing oil weak. We've seen all the commodities weak. Many of them are now negative year on year or close to it. So we've got this storm where bond yields are still high. They're actually, most assets year on year map the ISM really well. It's amazing. The business cycle is like this voodoo magic. And many people can see my threads on Twitter. I write about this a lot. I talk about it in Real Vision a lot. Is the year on year rate of change of the S&P, the NASDAQ, the bond yields, copper, oil, emerging markets, credit spreads, that all map the ISM. So right now, where are asset markets pricing? Well, interestingly, bond yields are pricing the ISM at 63. So they're way above where the market...
What does that mean, Raoul, for people who don't follow fixed income and ISM?
It means that the bond market is pricing inflation plus growth way far higher than the ISM survey itself. Now, okay, but that's not consistent with anything else. The S&P is pricing it at 45, full recession. The NASDAQ, 42, bigger recession. Growth technology stocks, 35, big recession. Copper, 45. The dollar, which year-on-year rate of change also maps, is pricing growth at 40 or just below 40 now. So most asset prices are pricing in a sharp recession.
The conflicting upside signal comes from a potential double bottom pattern on Bitcoin's longer time frame charts against the United States dollar. Double bottoms are bullish reversal patterns that resemble the letter W due to 2 lows and a change in direction from downside to upside. The cryptocurrency would complete the pattern after rebounding toward $25,000. A W-shaped price move in an ideal scenario could be followed by another sharp move higher, a double bottom breakout.
And we've seen that in 2000 and 2000. We saw it in 1990. We saw it in 2008. We saw it in 2018. The bond market deviates from ISM. ISM starts falling, and then this Wile E. Coyote moment, and yields start collapsing. Let's see what happens. But the next couple of months, I'm expecting it to be signaling a full recession, and we'll get to the tipping point where bond yields start to fall. It'll start affecting asset markets. So I'm not a believer we go to new lows. I've done surveys after survey and seen all the surveys on Twitter. 70% of all respondents in crypto and macro think equities go to new lows.
So how do you think Bitcoin will perform in a recession? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.